Welcome to The Explainer. Today, we are decoding a massive market shift that could seriously define your entire 2026 portfolio. A huge capital rotation is happening right now, and if you're not paying attention, you could get left behind, still holding on to last year's crowded AI hardware trades while the smart money is quietly slipping into the software of tomorrow.
So where is this all coming from? Well, it's built on a massive, almost painfully large data set. We went ahead and tracked 50, that's right, 50 of the internet's top finance creators. We're talking about the high-signal YouTubers, the deep value guys, the aggressive growth hackers, and we watched them for an entire year. So this isn't just one person's opinion. It's what you get when you synthesize a powerful emerging consensus.
You know, we went through over 10,000 hours of their content. We logged every single buy alert, every conviction rating, every sector call, all to answer one critical question. When you strip away all the noise and all the hype, what is the single stock with the absolute strongest, most undisputed consensus for 2026? But here's the thing. The answer isn't just some ticker symbol. The result was genuinely surprising, actually. It's a signal. Think of it like a flashing red light on your dashboard, indicating a fundamental change in where the most influential voices in finance believe the next $1 trillion of value is about to be created.
Okay, let's dive right in. First things first, we have to understand the big picture, the macro-level shift, because that's really the why behind all the specific stock picks we're about to get into. The entire landscape is changing.
The consensus on this is crystal clear. If the last couple of years were all about AI hardware, the whole picks and shovels play, then 2026 is going to be all about the application layer. So what is that? It's simple, really. It's the software companies that actually use all that crazy computing power to build products, solve real problems, and, actually generate revenue. The entire conversation has shifted from who builds the chips to who's using those chips to make a ton of money.
And this slide right here illustrates the trend perfectly. Just look at the data on NVIDIA. For the past 2 years, it was the undisputed king, no question. But look, sentiment has dropped a staggering 40% among these key influencers. Now, this doesn't mean they're all panic selling. No, it just means the new capital, the next big wave of investment, isn't flowing there anymore. The consensus is that the easy money's been made because the valuation now reflects years of absolutely perfect growth.
So, as that capital rotates out, it has to go somewhere, right? Let's break down the winners and the losers, where the money is leaving and where it's flowing to right now.
The data shows a really clear exit from 2 specific areas. First, pure-play electric vehicles, and that's excluding Tesla. Mentions of companies like Rivian and Lucid have just vanished from the top picks lists. The thinking is that in this high-interest rate world, the huge amount of capital you need to scale manufacturing and compete is just too much of a burden. The other surprising loser? Apple. I know, right? Despite its fortress balance sheet, it's widely being called dead money by this community. They feel its AI strategy has been way too slow and uninspired, and that it's risking its spot at the top.
Now on the flip side, we have the new safe havens. These are the foundational stocks that are showing up in over 60% of the portfolios we tracked. And it's basically a dead heat between Amazon and Google. For Amazon, the thesis is 100% about AWS being the essential backbone, the utility provider for this entire AI revolution. For Google, the story is a bit simpler. It's a value play. It's seen as the cheapest, safest way to get AI exposure without paying the insane multiples of its peers, all while owning a super powerful, vertically integrated AI stack.
But let's be real, you're not here just for safety. You want some alpha. So let's look at the runner-up, the cult favorite that the aggressive growth investors are betting on for those multi-bagger returns. All right, the runner-up, the undeniable cult favorite, is SoFi. And what's really fascinating here is how the whole investment thesis has matured. It's not about student loans anymore. Forget that. The entire focus now is on its technology platform, which a lot of creators are starting to call the AWS for fintech.
The bullish case for 2026 really comes down to a few key catalysts. First, the growth of their tech stack, these infrastructure platforms called Galileo and Technesis that actually power other banking and fintech apps, that's expected to drive margin expansion and finally get it a tech valuation, not a bank valuation. Second, with crypto heating up again, SoFi's platform is seen as a free call option on the entire space. It is the unanimous pick for that high-risk, high-reward slot in the portfolio.
But there was one company that rose above all the others. It bridged the gap between value, growth, and even the current geopolitical climate. This is the one stock that actually united all the different investing tribes.
So, which stock was it? What's the one company that the value guys, the growth hackers, and the macro analysts all agreed on? The company they believe is poised to become the essential operating system for the entire 21st century?
The undisputed #1 consensus stock pick for 2026 is Palantir Technologies, and the shift in sentiment on this one has been absolutely extraordinary. I mean, just a couple of years ago, it was dismissed as a meme stock. Today, the analysts we tracked are calling it an indispensable piece of our digital infrastructure.
So why the dramatic change? Well, it's all about one initiative, their AIP bootcamps. This is Palantir's rapid deployment model, where their engineers literally go on site with a client and they install a working problem-solving AI solution in a matter of days, not months. This one strategy has completely supercharged their commercial growth.
And the result of those boot camps is what's really interesting here on this slide. For the first time ever, Palantir's commercial revenue is projected to actually eclipse its government revenue in 2026. This is what's being called the crossover event, and it's what Wall Street is laser-focused on because it proves the business can scale exponentially, way beyond just government contract. Fundamentally, the company is just firing on all cylinders. It is crushing the rule of 40. That's a key metric for software companies, where you add the revenue growth rate and the profit margin together. A score over 40 is considered excellent. Palantir is consistently scoring above 50. This is the new gold standard, profitable hypergrowth. Now, of course, the bears will point to the high PE ratio, and they have a point, but the consensus counterargument is that you just can't value a company with this kind of a moat on traditional metrics. The popular comparison everyone's making is to buying Amazon back in 2015. The focus isn't on current earnings, it's on the unbelievable stickiness of their platform. Once a company starts running its operations on Palantir, it's almost impossible for them to leave. But it's really crucial to understand this is not a sure thing. The bear case is very real, and it really centers on one key risk. The stock is priced for absolute perfection. If that commercial growth slows down even a little bit, the valuation could get cut in half. You're paying a huge premium for flawless execution, and that always comes with risk. So let's put this all together. What's the actionable strategy that emerges from this consensus? How can you actually position your portfolio for this big rotation?
The synthesized strategy is a classic barbell approach. The goal is to balance the safety of those foundational boring assets with aggressive high-conviction growth plays. It's really designed to weather any storms while still having massive upside potential.
And this slide lays out the recommended allocation perfectly. You've got a heavy 50% anchor in the safe havens, Amazon and Google. Then an aggressive 20% allocation to the #1 pick, Palantir. And the final 30% is for your more speculative plays, like SoFi or even crypto, giving you that high-risk, high-reward exposure.
So, after analyzing 10,000 hours of content, the consensus is pretty clear. The market is rotating from hardware to software. Palantir is the flag bearer for this whole movement, supported by a bedrock of Amazon and Google. But in the end, the final decision is yours. Is this the definitive play for 2026? A true software monopoly in the making? Or is the real winner still hiding in plain sight?